When looking at our company through a financial scope, our troubles almost seem even more pronounced. When we look at them based on liquidity, leverage, and profitability ratios compared to their competitors and their historical past, we start to see more negatives than positives. So for our competitors, we view the two best as Hasbro and Jax. They're both publicly traded, and so all of their information is out and about, and we can access it. So Hasbro is probably our best competitor. It is close in market cap with 9.7 billion compared to our 11 billion, and Jax is very small with only 124 million on market cap, but it also still participates in the same market we do, which is toys and children's games. So some of the negatives we see right away is that liquidity, we are less liquid than our other companies, but necessarily it's not a terribly bad thing. But if you see where we're trending, that might become more pronounced. Also, our profitability is not nearly as good as Hasbro, which is a company similar to our size, so we should see close to, if not better, profitability ratios. We are better than Jax in these profitability ratios, but that is because we have better economies of scale due to our size and ability to produce toys at a larger rate with lower variable costs. Looking at our activity ratios, we have better accounts receivable turnover and average collection period, but our inventory turnover and other turnover ratios are not as strong. This is a more important metric because having turnover as a manufacturing company, you want that to be as high as possible. You don't want items sitting on shelves. You don't want that money being locked up. You want to be able to quickly get your product from end of its manufacturing right to the customer. So you spend as little amount of money holding on to it, and you can get it out and really do more with your business. So first one we want to look at is liquidity. It is an important metric to look at for our short-term operations. Strong liquidity ratios show that you are easily able to pay off current debt. So the ones we want to look at are the cash ratio, the current ratio, and the quick ratio. There is somewhat of a little bit of misconception though that a really high liquidity ratio is good, because sometimes that cash that you have sitting there to be a liquid company could be better used tied up somewhere else that can grow the company more in the future, rather than just being too worried about your short-term operations. So finding that right balance is the right thing to do. We also just want to keep in mind the difference between liquidity and solvency. We saw this a lot with the banks in 2008. A lot of banks had more assets than liabilities, but in the short term, they weren't able to pay those off because they didn't have the liquidity of the short-term, like cash and cash equivalents. They actually went under when they actually were a solvent company. So making sure your liquidity and solvent is very important. As you can see from this graph, we have lower liquidity than both of these companies. On one hand, it might make our company a little more risky, but it also means that we are able to produce and turn over our goods without using much cash. But also, as we saw from some of the profitability ratios, we're not doing a great job of it. So this might be a little bit of cause for concern that our liquidity ratios will keep going down in the future. And when we look at our historical liquidity ratios, both based on a normal graph and an index graph. And so the point we did with the index graph was we wanted to see how they moved together, starting at 100, and then looking at their percentage moved up and down. Because if you look at the other graph, you can see on the left side that the numbers for a cash ratio, or current ratio, or quick ratio are going to be off just because of the nature of the ratios, and they're going to be kind of stacked like that. So you can still get a good look, but when you index them together and show them starting at 100 and kind of the percentage moves from there, you can see that our liquidity has gone down over the last couple periods. So that's some little cause for concern, is if we wanted to be a little bit higher, around 1 for our cash ratio, and in between 1.5 and 2 for our quick ratio, but those are dipping lower and lower. So as of right now, we can pay off all our current debts, but we're trending downwards, so we want to try and reverse that trend and stabilize our liquidity. Next, I want to look at our capital structure. So this involves looking at debt to equity, debt to capital, and debt to total assets. So what this does is it kind of looks at how our company is set up based on the cost of equity and the cost of debt, and how we want to kind of look going forward. How leveraged do we want to be? What's the cost of getting leveraged? Everything like that. So we are considered an investment grade company. So we have been awarded a BBB+ credit rating. This allows us to get relatively cheap debt. It is important to understand the risks and rewards of doing this, however. Some of the pros are that you can expand faster in good times. If you have that extra capital from the loan, you can use that to buy more manufacturing plants or more marketing to try and increase your sales. So because of this increased money that you're putting into your business, you can generate higher returns off that. In theory, there's also some cons that go along with that, the higher risk. So you come along with the default risk. So this default risk exists is a lot of times when you get this debt, you're going to have to put some type of collateral up, so you could possibly lose your assets. Also, in bad times, you see this higher risk being kind of going over to not allowing you, if you have that expenses, these higher expenses now, and you don't get those returns or you don't drive revenue up, that's going to be a huge burden on your company. You're not going to be making as much money. So one of the things we wanted to look at, or one of the things that I've always stuck with me, was a quote from a distinguished collegiate doctor of finance, James Mahar, that reads, "Debt makes good times great and bad times horrible." And I think this kind of sums up exactly how debt works and how you want to incorporate it into your company. So next I want to look at the cost of debt for our company, Mattel. And looking at it, because they're a triple B plus company, I wanted to put it next to the Treasury, which is kind of considered the gold standard for loans. They always have the lowest rates because the U.S. government is considered the safest asset in the world. They're not going to go under, unlike some companies that can. And you kind of notice this too with our yield curve. As time gets higher, our yield curve is a little steeper, and that's because people might have more faith in our company today relative to the company 30 years in the future, when people have more faith in the U.S. government today and in the future. So our yield curve gets steeper, because if you want a loan 30 years from now from Mattel, people are going to need a higher return to get that. So that's looking at our yield curve, but we still have a very cheap access to debt. And along with us being very close to the Treasury, we also have something that the Treasury doesn't have, and that is a tax shield that comes with the interest payments. So as we take on more debt, we have to pay out more interest payments, but that in turn cuts into our taxable income. So our taxable income goes down, and we save money on taxes that way. So we pay the interest rate, but that is somewhat cut down even closer to the Treasury because of the tax shield that comes from the interest payments cutting away of our income. So doing that almost makes our cost of debt very cheap, and almost to the point of inflation. So we don't really have a ton of risk taking on that debt at the current time. So on these next slides, you can see our leverage ratios, both compared to our companies, our competitors, and our company historically. You can see that we are less than our competitors, so this almost looks like an opportunity for us to possibly take on some more debt and catch up to Hasbro on those profitability metrics we looked at earlier, and continue to outpace JAKKS and keep our competitive advantage that we have over them with big economies of scale by continuing to expand our operation. So in the past, you've seen us continue to increase our debt, especially compared to our equity and total assets. So what we want to do here is continue doing this, so our plans to kind of turn around our company can be implemented and not be held back or constrained by some type of capital requirement or lack of funds. So finally, we're going to look at the last financial ratios. We're going to look at profitability. So for this, we wanted to look at like our returns on our assets and our equity. So what are we getting out of what we put into the company, and also how profitable we are. So our margins, our ratios, looking at gross margin, EBITDA, which is earnings before interest, tax, depreciation, amortization, and our operating margin. So when we look at EBITDA, that's an important one to look at because it shows our earnings before our non-cash expenses like depreciation, amortization, and also shows it before interest and tax. So it looks at what is the business doing, everything that's related to the business in general, and our earnings that are or everything that all the expenses that are taken away from our earnings that are related to the business and are cash related. So it shows our cash turnover before our interest and taxes are paid out. Our gross margin looks at how well our sales are related to our cost of goods sold. So you want to see an increase in gross margin, which we haven't seen, which is cause for concern because of lower sales numbers. So increasing gross margin, we want to get that by, and we think we can achieve that by increasing our barriers to entry in some of our technological games and different things like that that we haven't been able to see in the past. And hopefully creating those barriers to entry and some pricing power will allow us to increase our prices without increasing our costs, or direct costs of the products, thus increasing our gross margin. We also want to look at our operating margin. It shows us everything we have to do besides our interest and tax. So it includes that depreciation and amortization, because in turn, those things do affect our buildings and our machinery and everything that goes into making the product in the long run. If we look at our profitability compared to our competitors, like I talked about earlier, we have worse returns than Hasbro. We all still have better returns than JAKKS in every return category. We also have a worse gross margin than Hasbro, which is something we need to look to turn around with our new strategy going forward, as well as EBITDA and operating margin. You can also see these have all been trending down in recent years. This is because of the technological shift, we believe, to technology and kids not using toys anymore, or at least not wanting to use toys as much and having that drive for them to sell. One thing, though, we saw that was odd with these ratios is that the return on assets actually spiked from 2014 to 2015 when all other metrics went down. So what actually happened here was, instead of our returns getting higher, causing our returns on assets to go up, we actually just sold off assets, making the denominator smaller. So we don't have that. So it boosted our actual return on assets. This is a graph that the index really helps because gross margin is so much higher percentage than all the rest in the return on assets, return on equity. So indexing them together kind of shows you how they move along. So even though gross margin has been declining a little bit, it's important to know that we have able, even in really low sales numbers, we've been able to somewhat monitor our costs, and they haven't absolutely destroyed us. Last, I want to look at the activity ratios. So these are how fast we run, or how efficient we run the business. So accounts receivable turnover, how are we collecting money, inventory turnover, how quickly are we getting the inventory out there, our fixed assets, our total assets turnover, how much are we turning on those, and our average collection period. So just like accounts receivable, how much are we actually getting that money brought in. So the activity ratios I wanted to look at. You can see that our accounts receivable turnover is better and we're getting that money back faster, but our total inventory turnover is not doing as well, and this is important for a manufacturing company like us. You want to see that inventory going in and out of the company quickly. We don't want to be holding on to it. We want to be meeting our demands, forecasting these demands very well. It's something we haven't been doing because we have been holding on to inventory longer, increasing our holding costs, and we need to increase R&D, I believe, to change that and change the trend on that. So here's our activity ratio. So even though we had the best collection period, we've seen that spike, and we're coming up close to our competitors now, which is a little bit of cause for concern. And also all of our turnover ratios are trending downwards, which is something else we don't really want to see. So all in all, we need to kind of try and change that and fix it. So just to recap, something we've kind of seen is that we're trending down in some areas, but we also have that ability to take on more debt, which in the long run should help us turn the company around and finance our strategy that we believe will really align all of our products and make the company profitable again, or at least trending back upwards.